You've probably heard it a million times from your parents. That one piece of financial advice that just felt, I don't know, a little old-fashioned. But what if I told you the numbers actually prove that this boring advice was one of the smartest moves you could have made? Today, we are putting that old school wisdom to the test. Does that ring a bell? For so many of us, especially in India, this was it. This was the peak of financial planning from our elders. And let's be honest, it felt a little dusty, right? We were all chasing the smart money, mutual funds, SIPs, stocks. Gold? That was for weddings, not for building serious wealth. But, well, it turns out the data is telling a very, very different story. So, get this. This is the hard data that might just blow your mind. Over the last decade, gold has delivered an average return of over 15%. That's more than the Nifty 50, which, as you know, is the index of India's top 50 companies. So it looks like Mom wasn't just being traditional, she was actually pointing to a serious outperformer. Okay, so it seems she was right all along. But look, this isn't just some one-time lucky guess. Let's really dig into the numbers that back up this age-old wisdom. The consistency here is what's truly staggering. We're not just cherry-picking the last 10 years. You can zoom out to 5, 15, or even 20 years and you see the same pattern. Gold has consistently beaten the Nifty 50. This isn't some short-term trend, it is a solid, long-term pattern of outperformance from an asset that, frankly, most of us wrote off as boring. So the big question is, what is going on? Why is there this massive global gold rush all of a sudden? Why is this ancient metal smashing records and beating modern markets? Well, it really boils down to four powerful forces that are creating the perfect storm. And just look at how fast things are speeding up. After the price peak in 1980, it took gold 31 years to hit a new high. The next time, it took 9 years. After that, just 4. And now, it's happening in a matter of months. The cycles are getting shorter and shorter, which is a huge signal that the market dynamics have fundamentally changed. So what are these changes? Well, first off, technology has made it incredibly easy for literally anyone to buy gold. Second, governments around the world are printing money like there's no tomorrow, and that's fueling huge fears about inflation. Third, let's face it, the world is a pretty uncertain place right now. And finally, and this is a big one, it's not just regular people buying. Central banks are on an absolute gold buying spree. Let's just talk about that money printing for a second. The US national debt alone is over $37 trillion. And to pay for stuff like that, governments often just print more money. But here's the thing, that doesn't create real wealth. All it does is devalue the money that's already sitting in your pocket. Let me give you a super simple example. Imagine there's an economy with just 100 rupees and 10 eggs. Simple, right? Each egg is worth 10 rupees. Now, what happens if the government prints another 100 rupees? Suddenly, you have 200 rupees chasing the exact same 10 eggs. Well, now each egg costs 20 rupees. Your money just lost half its value. That is inflation, and that's exactly why people run to assets like gold that can't just be created out of thin air. And it's not just individuals who are worried. Central banks are buying gold at a historic pace. China, for instance, has exploded its annual purchases from an average of 3,000 kilograms to over 30,000. India has boosted its reserves from 650 to almost 900 metric tons in just a few years. Think about that. When governments themselves are hedging against their own currencies, that sends a really powerful signal about where they think the economy is headed. Okay, so let's switch gears and talk about silver, gold's often overlooked sibling. Because while gold's story is all about financial safety, silver's story is all about industrial innovation. It is becoming an absolutely essential ingredient for our technological future. Just a decade ago, industrial use made up about 45% of all silver demand. Today, that number is a whopping 65%. I mean, this is a fundamental shift. Silver's price is now being driven less by investors and more by the relentless, non-negotiable demand from industries around the globe. And where is all this silver going? Well, think about the technologies that are literally shaping our world. We're talking solar panels, electric vehicles, smartphones, 5G tech, you name it. For a lot of these applications, there is simply no substitute for silver, and that creates a constant demand for it, almost regardless of the price.
Now, to really get the relationship between gold and silver, we have to look at one key number, the gold to silver ratio. It's pretty simple. It just tells us how many ounces of silver it takes to buy 1 single ounce of gold. But this little ratio can be a really powerful indicator of what's happening in the economy.
So the historical average for this ratio is somewhere around 67 to 1. But right now, it's over 92 to 1. That is a huge gap. It suggests one of two things. Either gold is way overvalued, or, what's more likely, silver is significantly undervalued. A ratio this high is also a classic sign of economic jitters, as investors pile into gold for safety.
Okay, so the case for gold and silver is pretty compelling. But how do you actually invest in it smartly in today's world? I'll give you a hint. It's not about buying more jewelry.
Let's be real. Investing in jewelry comes with a ton of baggage. You've got high making charges and taxes, you have to worry about purity, it's hard to sell quickly, and it's a pain to store securely. Digital assets, like ETFs, solve every single one of these problems. They have super low costs, guaranteed purity, you can buy or sell them instantly, and they're stored digitally. For a modern investor, it's really a no-brainer.
So your modern toolkit is actually really simple and powerful. You can go for digital gold or silver for direct ownership. You can use ETFs, which trade just like stocks, or you can even invest in specialized mutual funds. All of these are super efficient, low-cost ways to get precious metals into your portfolio. But hold on, before you dive in, you need a smart strategy. These are not get-rich-quick assets, and they definitely come with their own unique risks you need to be aware of.
And here's probably the most important thing to remember. Silver is way more volatile than gold. It's a smaller market, which means bigger price swings. A 10% dip in gold could easily mean a 20 or even 30% drop in silver. You absolutely have to be ready for that kind of ride.
And that's the key word for this whole strategy, volatility. This isn't a fixed deposit. The prices will go up and they will go down. Your investment is going to fluctuate, and you need a solid plan to manage that.
So here's the game plan, and the best ones are always simple. First, decide how much to allocate, maybe 10 to 20% of your portfolio. Second, please avoid putting in a huge lump sum, especially when prices are at all-time highs. Instead, set up a monthly SIP to average out your costs. Pick your digital method, and then, most importantly, just stay disciplined for the long haul. And here's what that could look like in a real portfolio. For someone who's around 30, a 10% slice for precious metals can add a really powerful layer of stability and growth potential, right alongside your equity and debt investments. It's all about building a portfolio that's more resilient and diversified.
So I'll leave you with this question. We have an asset that's been around for thousands of years. It's now being stockpiled by the world's most powerful governments, and it's absolutely crucial for our most advanced technologies. So is gold just the boring, old-fashioned investment your parents told you about, or is it quietly becoming the most essential asset for any modern portfolio? The data's in, now it's your turn to decide.